Hey guys, welcome to my YouTube channel. Here I'm back with another informative video. So the topic of today's informative video is real estate professional tax loophole. How you can save $50,000 legally. So have you ever looked at your tax return and cringed at how much of your rental property income is going straight to the Uncle Sam? If so, you are not alone. Real estate investors often find themselves frustrated by the amount they owe in taxes, but savvy investors know there's a powerful tax strategy that can help keep more of their hard-earned money in their pockets. That strategy, qualifying for real estate professionals status, one of the most valuable tax-saving tools available to real estate investors. So, why a real estate professional status matters. Under the normal tax rules, rental losses are classified as passive income, meaning they can only be used to offset other passive income, such as income from rental properties or limited partnerships. This creates a major hurdle for high earning professionals who generate significant income from salaries, business profits, and investment returns, incomes that passive losses cannot typically reduce. However, if you qualify as a real estate professional in the eyes of the IRS, everything changes. Your rental losses become fully deductible against any type of income, and including W-2 wages, self-employment incomes, stock dividends, and other active earnings. This means that if your rental properties generate a loss, you can use that loss to reduce your taxable income across the board, often leading to the tens of thousands of dollars in tax saving each year. So the potential tax savings is for high income earners. The financial impact of achieving a real estate professional status can be game changing by unlocking the ability to offset active income with real estate losses. Many investors see their taxable income drop significantly, sometimes resulting in $50,000 or more in tax savings per year. That money can be reinvested into growing your real estate portfolio, funding additional investments, or simply improving your financial security. So, what are the qualifying structures for real estate professional status? So, to reap these tax benefits, you must meet two key criteria set by the IRS. So the first criteria is to spend more than 750 hours per year in real estate activities. You must dedicate at least 750 hours annually to materially participating in the real estate activities such as property management, deal sourcing, renovation, tenant relations, or real estate brokerages. And this means real estate must be a significant focus of your professional time. And the second criteria for qualifying for real estate professional status is more than 50% of your working time must be in the real estate. If you have a full-time job outside of real estate, qualifying can be more challenging. The IRS requires that you spend more time in real estate activities than in any other occupation. This is why real estate professional status is most beneficial for those who are already heavily involved in real estate or have the flexibility to shift their time allocation. So, is real estate professional status right for you? So, how to find it? Achieving a real estate professional status is not just about checking off IRS boxes. It requires a strategic planning, proper documentation, and deep understanding of tax regulation. But for those who qualify, the tax benefits can be enormous, allowing you to accelerate your wealth building journey by legally minimizing your tax burden. So if you are serious about keeping more of your rental income and leveraging real estate as a powerful tax sheltering investment, it may be time to explore whether qualifying as a real estate professional is the right move for you. With careful planning and the right strategy, you can turn your real estate investment into one of the most tax efficient wealth building tools in your portfolio. If you're interested, I thought so. You're interested, let's dive deeper into the eligibility requirement and documentation needed to qualify for this powerful strategy. So, do you how to find that? Do you meet the strict real estate professional criteria? The IRS isn't going to hand out this lucrative tax break to just any real estate developer. To qualify as a real estate professional, you must satisfy two strict tests: more than half of the service you perform in all your trades businesses are in real estate trades businesses in which you materially participate. You spend more than 750 hours per year in real estate trades businesses in which you materially participate. Material participations means you actively involved in the operation of your real estate business on regular, continuous, and substantial basis. No armchair landlords here. So the following real estate pursuit count according to the IRS: development and construction of properties, acquiring and flipping houses, rental management and leasing of properties, being a real estate agent or broker. What doesn't count is being a passive investor, such as owning REITs, private equity real estate funds, and crowdfunding deals, etc. You need to get your hands dirty to qualify. An example of the incredible tax savings. Let's look at the hypothetical example to illustrate how powerful this tax designation can be. John and Jane are married and earned a combined W 2 income of $750,000 per year. They also own a portfolio of 12 rental properties that generate $150,000 of taxes losses annually, mostly due to depreciation and deductions. And without real estate professional status, John and Jane can't deduct a penny of those rental losses against their 750,000 of ordinary income. So the losses are suspended until they either sell the properties or generate enough passive income to offset them. So what a waste of depreciation. However, let's say Jane quits her day job, focus full time on managing and growing their rental portfolio. She keeps meticulous logs showing she spends 1,000 plus hours per year on the rentals. John and Jane can now fully deduct the $150,000 of rental losses on their tax as real estate professionals. So at their 37% marginal federal tax rates, this saves them a whopping $55,500 in income taxes. And that doesn't even factor in state income taxes on the fact that the Jane's income is no longer subject to that 15.3% of self-employment tax. RN qualifying for real estate professional status probably saves them over $70,000 per year in this example. So documentation is the key to surviving an audit. So some of the best practices to put yourself in the best position without an audit: log your real estate hours contemporaneously in a timekeeping app like Doggy, House Tracker, or the Excel spreadsheet. Write a detailed narrative of your real estate activities for the year, then Gather corroborating evidence of your material participation like property management, contract, receipt for travel to properties and have a business partner, property manager, tenants, contractor, etc. So hope this video will be very helpful for you. So for the most helpful stuff, kindly follow and subscribe my channel.